Hi everyone, hope you're all doing well. Welcome to my Etoro profile and market review. So I've been meaning to make this video for a while, so I apologize for the delays, but let's get into it. So first we're going to talk about our performance so far. So we're up almost 22% for the year, with our strongest months being November and April. And we'll go into why that was in a bit. So from January to June, the first half of the year, we saw that the first quarter suffered great losses, especially in the month of March. Indices dropped as low as 13%, but despite this, during the first quarter for us, we managed to maintain a drawdown of less than 1%. During this period, we were heavily focused on mitigating risk. We did this by diverting capital into stocks that were seen as more stable or would maybe benefit from the pandemic. This includes stocks like Microsoft, Amazon, Zoom, and we also decreased our currency positions, and also our trade durations, so how long we held our trades for, and all of these together helped us mitigate that high volatility that we saw in the market earlier this year. So now talking about July to November. So July, we saw some similar trends. So we saw a pullback in July and then market recovery as spending began to increase and people began to ease about coronavirus. It was summertime, so people started to go on holidays and things like that. But then October came around and we saw a drawdown of 0.87%, and this was due to either Brexit fears or the US election. Now, the markets were very volatile in this period, but we managed to stay invested, and not only stay invested, but we increased our positions. And we did this because it's important to realize when is the right time to separate noise from the actual fundamentals. A lot of these articles came out, it was all speculation, and no matter who won the election, Amazon would have still performed the way it did, and so would have many other stocks. So we stayed in the markets. We didn't stay sidelined, and we saw that it was of great benefit to us, as the month following October we saw our highest gain at 9.71%. So we took advantage of those lows. We took advantage of fear in the market and volatility, and we were smart about it, so we saw the returns. This highlights a key lesson that I learned from the book, The Intelligent Investor by Benjamin Graham. If you have time, I recommend you pick it up and explore some of the concepts. One of them was to utilize volatility and understand how to manage risk during times of crisis. So that was just a sort of overview of the year, and now we'll go into some stocks that I think are interesting at the moment and that I might add to my portfolio. So talking a bit more about Amazon, they were an example of one of the companies we decided to invest in. They dropped 11% from January to March, but recovered and increased upwards to 70% towards July. And this was thanks to not only an increase in e-commerce purchases, but their Amazon Web Services, which performed really well this year, and has now represents 10% of their company. So it was companies like these that we invested in, and that allowed us to see our gains in April, May and June, and then in the second half of the year we continued the same cycle. So talking a bit more about Amazon, their stock jumped I think overall 79% this year. Their net income was at $6.3 billion, over $4 billion from last year. I believe online shopping still has a lot of room to grow, because we're seeing things like a newer generation coming in with credit cards and debit cards, so they are more likely to gravitate towards online retailers and sources like Amazon Prime for entertainment over going to physical shops and TV as a mainstream source of media and entertainment. Also, people who weren't comfortable with using Amazon services before reported that they were very satisfied, as they needed to order necessities online during the pandemic, and this encouraged them to use the Amazon services again and shop more. So this was a good period for Amazon to advertise themselves, and they definitely gained a lot of new buyers, and not only buyers, they gain a lot of retailers. We saw a large increase in third-party vendors and small to medium-sized businesses increase their distribution on Amazon. So it'll be really interesting to see how a company that caters to such a large demographic is able to expand. They're coming out with things like Amazon Pharmacy and Amazon Fresh, Amazon Web Services, which I touched on earlier. They are definitely a strong driver involving themselves in things like data storage and data analytics. They're working with AI to health and medicine to developing restaurant chains. So I think it's really interesting to see where AWS takes Amazon. Amazon Web Services now represents 10% of the company's reported net sales. So although growth in AWS has slowed down, they're still definitely pulling in more money than they ever did before, up $7 billion this quarter compared to the same quarter last year. So moving on from Amazon, December overall, I'm trying to explore some cyclical stocks because we're really seeing momentum for tech decrease. Tech overall had a very strong year. They were up 33% since the beginning, but only 4.3% since October. So you can see that the hype for tech has died down a bit. Investors may be cautious because November was such an active month, and maybe they're waiting for news on the vaccine. Moving on to some stocks that I've decided are interesting and I'd like to discuss with you. If I do miss anything, or if there are some stocks you'd like me to cover, please let me know. Obviously I won't be able to do an in-depth analysis for all of these stocks, but if you would like me to do a video like that, please let me know. So moving on, first we're going to cover airline stocks. So one of the first questions I got were my thoughts on investing in airline and travel stocks, especially since the vaccine news came out. So since COVID, of course, airlines have been hit the hardest, losing on average probably two-thirds of their stock prices. Vaccine approval could definitely influence the recovery. You can see that when the vaccine was announced, there was an increase in TSA flight screenings, showing that more people were starting to fly. During the first ease of lockdown, we did see a spike in air traffic as the lockdown began to ease and people going on holiday. So if a vaccine is approved and shown to be effective, we will definitely see a similar or greater effect. Thing is, it's important to invest in companies that are not carrying a lot of debt right now, and also reducing their cash flow, as most airlines are burning through hundreds and thousands a day through the cost of things like maintenance and daily expenditure. So one stock, if we are going to decide about airline stocks, one stock would be Delta Airlines. So far they reduced their cash burn and expenses dramatically. They also have one of the highest cash liquidity positions, but they still have a large debt. So depending on how soon people can travel, it will give us an indication of whether or not it's a good time to invest in airline stocks, because we have to think about not only recovery but survivability. In terms of travel, however, Airbnb is a stock that I think is very, very interesting. They've recently decided to go public out of necessity to raise capital to keep the company afloat. It's essentially a rental marketplace for holiday homes, and since 2015, bookings have more than quadrupled, growing 50% year over year. They offer getaways both nationally and internationally. With a market cap at 93 billion, they're in a good position to dominate the holiday home and the rental marketplace. And I'll go into why in a bit, but quickly, they're currently priced at 157, which I believe is a bit too overvalued. They just went public, so there's a lot of hype around the company. So I'm waiting for the right price to enter. I really like the business model, and with the users at 150 million, it's hard to overlook a company like this. So why am I still thinking about investing in Airbnb? So what makes Airbnb different from other companies is its ability to perform in the next year and the coming years. So obviously I talked about debt earlier when I was talking about airlines. So Airbnb is a system that relies on other users from for hosting, and compared to other large chain hotels, they have a relatively lower cost of maintenance. So, for example, a company like Uber works well and they were able to survive because they have drivers with their own cars. They just run a software and infrastructure. So the same idea applies here. The vision for us is about recovery in the coming years. So if they can survive this period, then they can be sure to capitalize when the time is right, and get a large percentage of the market share when a lot of these large chain hotels are being forced to close. Something interesting I read was that 22% of hosts indicate they chose to become a host after initially being a guest. So there's still a large growing demographic from millennials to seniors, being both hosts and guests. So Airbnb offers over 7 million listings. So I definitely think Airbnb is in a very strong position to dominate the hotel market in the next few years. Like with any stock, however, there are drawbacks that we have to consider, like legal and COVID restrictions. Although the business model is very attractive, it's currently, in my opinion, priced too high. And I've just found out that the UK is going into Tier 4 effective of tomorrow, and a lot of countries are now off access, in between international access. So right now I'm just waiting for the right price and the hype to die down before I put my money in Airbnb, but it's definitely a company that is on the list. So moving on to solar companies, they've been a big part of our portfolio this year. Solar companies are looking strong so far. For example, this year we've seen Solar Edge gain up to 83%. Overall, companies like Canadian Solar and Sunrun will continue to be a part of our portfolio for the long term, because solar is a big part of technology today. It's becoming very popular, efficient, and cost effective as countries are really pushing that cleaner energy motive. We've seen Biden in his election pledge for cleaner energy in the US and his energy tax. Also, the UK, as of November the 15th, is signing a 15-year deal to build a large solar park here in the UK. So, as well, in terms of resident installations, we've seen an increase. More people are installing solar systems into their homes, and the levels of installations are similar to pre-pandemic levels. So it really gives a testament to how popular solar technology has become over these last few years, and I definitely expect it to rise a lot more in the next few years. In terms of e-commerce, Alibaba has become one of the largest e-commerce companies in the world, with a current revenue at 72 billion, an increase of 35% year over year. So they are really dominating the market in terms of e-commerce and retailership. They currently experience a dip, however, due to AT&T shorting them in response to China's new regulation and crackdown on big monopolistic companies. The plan, however, is to make selling products online for smaller business owners easier and more affordable, which could benefit the economy and more as a whole, and promote growth on the e-commerce platform for small customers to help expand their businesses online. So I think China's regulations would actually benefit the platform itself a lot. So I'm looking to explore more e-commerce purchases, finding companies with their own niche like Shopify, Etsy, and Jumia. So now moving on to EV stocks. I got a question, which was what are your thoughts on EV stocks and their bull run these couple of months? Is it a bubble, or do the markets have the value we see? So we frequently traded NEO this year, who's seen more than a 1000% return. So now I'm trading NEO more cautiously as it approaches all-time highs. So I'm starting to trade NEO based on appropriate valuation, as NEO as a stock is currently selling at 20 times its expected sales. So I view NEO as more of an energy technology company, which is why I still have it as part of my portfolio, as opposed to a pure automotive company. So I do think there is a lot of potential for NEO for growth, but it's just priced too high at the moment. Also, its most recent quarterly reports were very positive. So we'll have to wait for the Q4 reports to come out before I start to invest more, as this seems to be their strongest month in terms of sales and deliveries. Meanwhile, however, I'm looking into General Motors. They're set to start rolling out an all-electric SUV. Currently, NIO are being compared to GM, especially since NIO just overtook GM's market cap, beating them by around 1.6 billion. NIO is trading at 4.4 as of the time of making this video, and they're up 620% in the past 6 months, whereas General Motors is trading at a similar price of 40.40, and they're up only 44% over the past 6 months. So NIO has clearly seen a lot of growth and expansion, a lot more than GM has, but it appears to be slowing down. When we compare spending on research and development this year, NIO has spent 628 million and General Motors has spent 6.8 billion, 10 times the amount NIO is spending. On top of this, General Motors has said that they would spend 27 billion in their EV development in the next 5 years, while NIO is starting to cut funding for research and development in the next few months to focus on expanding and selling their product. General Motors also launched an entry-line model to EV cars this year in China. It's called the Honghuang Mini EV with a starting price at just $4,200. It's become the most sold EV stock in August with 15,000 units sold, and Tesla followed by 11,800 units sold. So I'm definitely keeping an eye on General Motors and EV as a whole. In the near future, it's definitely going to be a big part of our future in terms of energy and energy stocks as well. But right now it's just about waiting for the right price. Palantir is another great company I'm investing in. I believe Palantir was strong from the start. I wrote a report discussing Palantir and the future of data management a while ago during the time of their IPO. So it's recently begun to take off. They're showing currently a revenue at 55% year over year. So while they are working with the government, they are expanding into the public sector with things like finance and transportation, health, manufacturing, everything you can think of. Their initial concerns were that they only had a few customers, and their top customers being from government contracts, but they've since picked up 50 new contracts worth 5 million each. And you can see this really having a positive effect on the company as a whole, because they've reported that their commercial revenue is increasing at 35% year over year, which shows a good sign of diversification and expansion. Citron shorted Palantir recently, which brought the price down a bit, so I entered then, but I'm hoping it keeps up the momentum that it is, and it will prove to be a solid long-term stock. So biotechnology is another industry I'm really interested in. You've got stocks like Bluebird Bio, Johnson & Johnson, Novavax and Regeneron, and a couple of other CRISPR therapeutic stocks. So as a student of science, I believe I've got a good insight into how the medical technology being developed today can affect our future. And biotech overall has outperformed the S&P by 40% this year. Without a doubt, one of the biggest advancements in the history of medicine is gene therapy and CRISPR therapeutics. It will literally be life-changing. And prices for a lot of pharmaceutical companies are more stable and not overhyped. So I feel like now is a good time to get in, as opposed to something like tech. Clinical trials right now are increasing in success this year thanks to funding, thanks to a huge increase in funding, but it's important to know that these trials do take time, and when we invest in biotechnology companies, we will be in there for the long run. 2 cancer trials are already in phase 1 and 2 and looking promising by CRISPR therapeutics. Johnson & Johnson, also wrote a report on earlier this year, are a very, very stable company. So although companies like Johnson & Johnson, there's not a lot of room for growth, being how big they are, they still provide a very good dividend payout. They've been increasing the dividend for 14 years straight, so it looks like a very stable company. And also they recently backed Moderna, another company who's shown some positive positive results regarding testing for COVID and developing phase 1 antibodies. Anagen, on top of involvements with COVID, are also diversifying into antibody treatments. So overall, there's a huge upside into biotech, and it's definitely going to be a huge focus for me. Facebook's another stock I'm interested in, with a 52-week low at 137 and a high at 304. They've got a PEG ratio right now of 0.9, which shows that they are trading at fair value. Profitability is currently at 32.1. They've got a market cap of 775 billion, with 5 billion of that being in cash. Currently, analysts have the stock at a 1.8, which is a strong buy, with a price target of 321. It's currently at 372. In terms of revenue, we're looking at 22% year-over-year increase from 2019 to 2020. They beat Q3 expectations, adjusting profits per share up 13%. Currently pricing their EPS at $2.40. The advertising is the main reason I've decided to consider Facebook. You've got more people at home using social media, and because of COVID, you've got all of these companies who are now starting to advertise across platforms like Instagram and Facebook. With a new generation added every year to social media, it's just one of these things that are likely to grow and become more popular. And they've recently faced some controversy due to antitrust lawsuits, but and that seemed to bring down the stock 2%, but they still outperformed most of the FANGs during that time. The aim was to break up these big monopolistic companies, so Facebook could therefore dip further, which could present a good buying opportunity, as I believe the fundamentals for these companies are still very strong. Dropbox is another company I'm paying attention to, with a market cap at 7.47 billion. They're basically a pay-as-you-go service where you rent cloud space, focus on storing and managing data on a virtual server. Families and businesses both use them, so they've got a large demographic in terms of user base. Due to COVID, more people have become reliant on working from home. This exposure to online data management proved itself to be not only reliable but secure, and it gave businesses that would have never used cloud services before an incentive to promote permanently integrating cloud services as a part of their business, and influencing things like moving all physical documents online for the near future. We've seen companies like DocuSign grow, almost tripling its stock price, and Dropbox is no doubt in a strong position for growth, as their pay-as-you-go system provides a strong recurring revenue that we can see by an increase in number of premium memberships purchased. Dropbox's expansion with infrastructure and software as a service has allowed many businesses to access their work applications specific to their company all at home. So without having to download anything on their PC, they can access anything that they would need to for their work, which has definitely improved the lives of many people working from home. According to the Gartner report, the worldwide public cloud service market is forecast to grow 6.3% in 2020 to a total of 257 billion, up from 204 billion in 2019. And by 2022, desktop as a service, which basically supports people working from home, remote working, is predicted to grow up to $2.5 billion from 2019, being at only 500,000 in 2019. So you can definitely see that there's an increase in the demand for cloud services, and there's definitely good growth for this sort of industry. Dropbox so far is a very stable and profitable company, and it's definitely in a strong position for something like an acquisition or further integration into many other business models, which makes it an interesting stock to keep an eye on. So that concludes some of the stocks I had in mind and some of the industries I'm taking a look at. If you do have any thing I want to cover, please let me know. I will definitely go into a lot of detail. But to conclude the talk, I had some questions from the comments. So one of them was, if I'm adding more money, should I copy open trades or not? So I said yes, and the reason is because the stocks that I have in my portfolio all make up a balanced system. They all balance each other out. So even if you invest and the stock dips, it may affect the price, but without copying all trades, you will only copy my most recent trades. So some positions that I tend to hold for a long time, so I would rather see a slight dip rather than miss out on a trade completely. Also, there are periods like in the last 2 weeks where I trade less frequently. So I do build my portfolio so everything is well balanced. So that's why I recommend you copy all trades. And if you do decide to copy, I recommend you copy with I recommend you copy for a couple of months to a year. And you can see why, because if we take a look at our chart, you can see that profits and losses are spread throughout the whole year. So the first 3 months I might be in a drawdown, but then the next month I'll be in a huge upside. So you can copy with any amount. I recommend 1,000, but any amount is welcome. And some more stocks I had in mind. So there were a few other industries that I weren't able to cover. Real estate stocks like Care Trust and SKT Tango Factory. Financial stocks like Square Inc. and PayPal. Also, I didn't touch on semiconductor stocks, but we have a few semiconductor stocks in my portfolio because naturally, as we see an increase in demand for computing power to match requirements for cloud computing, AI, autonomous driving, semiconductors definitely have a lot of potential for growth. And I think that concludes. Yeah, I think that concludes our talk for today. If you have any questions, feel free to leave them in the comments under this video. I appreciate your time for watching this, and take care, and I'll see you all in the next one. Thank you.